Hello guys, this is Heath Tapa from NorthernInvest Technologies. Here is the update on the markets for June 7th, 2026. So the current market regime that we are looking at around this cycle is basically we think that the markets are kind of showcasing a late cycle inflation reacceleration regime. So when we are looking at the overall theme on the market, what we think is that it is basically a growth driven market that remains positive, but the inflation is definitely reaccelerating and liquidity is tightening at the margin, and the volatility is rising from historical low levels. Now, if you look at the overall volatility in past 1 month, I think we didn't see much of the volatility because there were so many factors that were suppressing the overall volatility in the market. The market basically rallied because of the AI-led earnings growth. We thought that the market, the economy is resilient. The Fed cuts are going to be later in 2016. So there wasn't much of a big surprise, but I think in past few days what we have seen is that markets are realizing that there could be an inflation surprise in the future. The energy prices have remained almost at the level during the start of the Iran conflict, and the prices haven't come down dramatically, and that can create a lot of pressure, especially how we are figuring out what the inflation would be for the future. And the Fed expectations, especially the policy expectations, are also changing as the circumstances remain kind of dire across the energy sector, and also the job market and the economic indicators that are coming in terms of the overall resiliency, showing a very good growth and stronger employment, which can have a bigger effect on what the Fed policy might be later down in 2026 Q3 and Q4. So the recent market sell-off in semiconductors and AI related names kind of illustrated how crowded the positioning has become in past like 2 months. And also obviously the volatility spike is because of the sell-off that we have seen on Friday. Now, the overall signal is definitely not showcasing that we are going towards recession. I don't think that this is a signaling of any kind of recession phenomena that might happen in 2026. What it's telling us that there is high uncertainty around inflation, Fed policy, energy prices. It could resemble the 2018 Q4 of kind of a timeline when Powell was the new chair coming in for Fed chair coming in, and the market was uncertain about what the policies would be, and we saw a very similar kind of a drawdown in the overall index. So we can expect that to happen, but I guess I'm thinking that it still has some bit of a time. May not be in June or July, maybe later down the line, but definitely there would be a lot of uncertainty involved in how the new Fed chair is going to be dictating the policy guidelines for the United States. And from the growth regime standpoint, what we see is that growth is definitely decelerating. If you look at it from a labor sentiment perspective, it has always been lower, but somehow most of this current employment or the payroll has been surprisingly positive, which is very strange if you look at it. Like if you look at the unemployment rate, which is being given to us is around 4.3%, which is historically a very low number. I would think there is a huge margin of error as well in this number, because 4.3 seems to be a very low number overall. Looking at the US population and trying to figure out how many people are unemployed. AI infrastructure spending has become very strong. Manufacturing led to data centers remains definitely supportive. However, we are looking at consumer spending that is weakening. Retail traffic is slowing down. Credit card usage is increasing, and higher energy costs can act like a tax on consumer. So from the overall growth standpoint, I think AI capex, stronger labor market, infrastructure spending, corporate earnings, they are positive, whereas higher oil prices, weak consumer demand, higher financing costs, and geopolitical uncertainty, they are basically negative for the growth. Now, from an inflation standpoint, if you look at it, there are several developments that are pushing the inflation higher. Okay, the oil definitely is sticking towards that $100 per barrel range. Energy supply disruption is causing a bit of a problem. Shipping cost has gone up, fertilizer costs have gone up. Food inflation is definitely higher. And then the tariff-related pressures are playing again, as the rhetoric from the White House is constantly changing. So what we see is that I think we see a sticky inflation overall. I would disagree with Kathy Woods on this. Definitely, she thinks that it's the technology is basically decelerating the overall inflation, but that's just one part of the story. But you have to look at all the other factors as well in terms of services. It's not just in terms of services, but in terms of housing, insurance, healthcare. And also energy, transportation, commodities. Like, you have to look at all of these factors that can drive inflation higher. So the macro interpretation on the inflation is that there is no longer merely lagging issue. It has become the primary risk variable again. Markets are increasingly concerned about this, and that might again play into a picture in terms of what the Fed policy is going to be by the end of 2026. Now, from the liquidity standpoint, the liquidity hasn't been improving as much. Like, the Federal Reserve remains cautious because inflation remains elevated. So recent FOMC communication indicated that policymakers may need to keep policy restrictive for longer than previously expected. Okay, so that means that the financial conditions can tighten modestly. The credit is becoming more selective, and the real interest rate remains restrictive. Okay, so Chicago Fed financial conditions data still indicate the conditions are not severely tight by historical standards, but trend is less supportive than during the 2024-2025 easing period. So from a liquidity standpoint, if you look at it, especially, let's say, if you look at these metrics on Fed policy, that seems restrictive. Bank lending neutral to tight, credit spreads manageable, liquidity for equities is good, and the global dollar liquidation is kind of tightening. So what is the overall conclusion? So if you look at it, we think that from a macro standpoint, we are in a late cycle expansion with inflation reacceleration. Okay, the primary risk is definitely inflation. Secondary risk is energy shock, and you have the growth outlook, which is positive but slowing, and then you have the liquidity outlook that could be restricted but not crisis level. Okay, the probability of recession in next 12 months is moderate to probably low, and the probability of soft landing or slow growth is higher. Okay, so the key variable to monitor over the next 60-90 days is definitely the oil price and the pass-through into inflation expectations. This is the update for June 2026. I'll talk to you guys soon.